Right now, while you're watching this video, someone just earned $2 billion in their sleep. Not through work, not through innovation, but through a mathematical mechanism that's been extracting wealth from humanity for centuries. Meanwhile, a factory worker who started at age 20 will work 40 years, 50 weeks per year, 5 days per week to earn maybe $2 million before taxes. That's a 1,000 to 1 ratio. But here's what they don't tell you. The wealth gap isn't an accident. It's not market forces. It's a mathematical certainty built into a system that was designed in 1694 and perfected in 1913. And the trapdoor? It opens every time you hear the word interest. Because here's the thing nobody explains. When banks create loans, they create the principal, but never create the interest payment itself. Let that sink in. The money needed to pay back loans doesn't exist in the money supply. It's mathematically impossible for everyone to pay their debts. This isn't a theory, this is arithmetic. And today I'm going to show you exactly how this mechanism works, why it guarantees perpetual debt slavery, and who profits from humanity's mathematical checkmate. They tell you that banks lend out depositors' money. They tell you that interest rates reflect risk and time preference. They tell you that if you just work harder and save more, you'll get ahead. Every single part of that story is a lie designed to hide the most profitable con in human history. Banks don't lend money they have. They create money when they issue loans through a process called fractional reserve banking, or in modern systems, through simple ledger entries. When you take out a $100,000 mortgage, the bank doesn't withdraw $100,000 from a vault. They type $100,000 into your account and simultaneously create a $100,000 debt obligation. Money supply just increased by $100,000. But here's the mathematical trap that makes this system a wealth extraction machine. They created $100,000 in principal, but you owe $105,000 at 5% annual interest. Where does that extra $5,000 come from? It doesn't exist. It was never created. The interest payment must come from the existing money supply, which means someone else must go into debt, must take out a new loan, must create new principal, just to generate the money you need to pay your interest. Well, this is why total debt always expands. It's not human greed, it's not poor planning, it's mathematical necessity. The system requires exponential debt growth because the interest was never created alongside the principal. Let me show you the 7 stages of this debt trap mechanism that has destroyed every major civilization that implemented it. Stage 1 is the monetary inception. A centralized authority, whether it's a king, a parliament, or a private banking cartel, gains the exclusive right to create the monetary unit. In England, 1694, the Bank of England was chartered with this power. In America, 1913, the Federal Reserve was given this authority. The public is told this creates stability and prevents chaos. What it actually creates is a monopoly on money creation with a built-in profit mechanism. Stage 2 is the principal creation without interest coverage. Banks create loans, the principal enters circulation, but the interest payment exists only as a future obligation. If the total money supply is $1 million and total debt is $1 million at 5% interest, then $50,000 is owed that doesn't exist in circulation. This is the original sin of the system. Stage 3 is the forced competition for scarce interest payments. Since the interest wasn't created, borrowers must compete for existing money in the economy to make their payments. Businesses must outcompete each other. Workers must bid down their wages. Assets must be sold. This creates the illusion of a free market, but it's actually a game of musical chairs where 5% of the chairs are mathematically missing. But here's where it gets truly diabolical, because stage 4 is the debt rollover cascade. When individuals and businesses can't find the money to pay their interest because it doesn't exist, they must either default or take out new loans to pay old debts. This is why credit card debt rolls over, why governments issue new bonds to pay interest on old bonds, why mortgages get refinanced. It's not financial mismanagement, it's systemic design. Each new loan creates new principal, but also new interest obligations, making the problem exponentially worse. Stage 5 is the collateral seizure mechanism, when defaults inevitably occur. Because the mathematical trap closes, the lender seizes real assets, your house, your car, your business, your land. Notice what's happening. The bank created money from nothing through a ledger entry. You provided real labor and real assets as collateral, and when you can't pay with money that was never created, they take your tangible wealth. This is the wealth transfer mechanism. They trade fake money created from nothing for real assets built by real human effort. Stage 6 is the Cantillon Effect amplification. Those closest to money creation, the banks themselves, the financial institutions, the connected corporations, they receive newly created money first before prices adjust. They can buy assets at yesterday's prices with today's money. By the time that money circulates to wages and salaries, prices have already increased. This is why asset prices like stocks and real estate explode while wage growth stagnates. It's not a skill gap, it's a proximity to money creation gap. And stage 7, this is where most people never look, this is the sovereign debt endgame. When private debt becomes unsustainable, governments step in with bailouts, stimulus and debt monetization. But governments are also trapped in the same mechanism. They issue bonds, creating principal, but owing interest. When they can't tax enough to pay the interest, they issue more bonds. This is why national debts only go in one direction. Up. The United States federal debt was 1 trillion in 1980. Today, it's 36 trillion. That's not 45 years of bad luck. That's mathematical inevitability. And here's the kicker. When government debt becomes too large, they have only 3 options. Explicit default, which destroys the system's credibility, austerity, and taxation, which triggers social unrest, or inflation, which is a hidden default that erodes the purchasing power of everyone holding the currency. Guess which option they always choose? Inflation, because it's the invisible tax that people don't understand and can't protest effectively. Now let me show you this pattern in history, because this isn't speculation, this is documented fact. Rome didn't fall to barbarians, Rome fell to currency debasement and debt. When Emperor Nero began reducing the silver content in the denarius from 95% to 85%, he was inflating the money supply to pay government debts and military expenses. By the time of Emperor Septimius Severus, the denarius was only 50% silver. By Gallienus it was 5%. The money became worthless, trade collapsed, the legions couldn't be paid, and the empire fragmented. The mechanism: create more money units, devalue existing units, transfer wealth from savers to debtors and money creators. Spain in the 16th century controlled the world's largest silver mines in Bolivia and Mexico. More silver should have made Spain richer, right? Wrong. The Spanish crown borrowed against future silver revenues, paying interest to German and Italian bankers. When silver production couldn't keep pace with debt obligations, Spain defaulted in 1557, 1575, 1596, 1607, 1627 and 1647, 6 defaults in 90 years. 6. Each default transferred Spanish assets to creditors. This is the same pattern. Create monetary expansion, create debt faster than wealth creation, default transfer assets. Weimar Germany, 1918 to 1923. The government needed to pay war reparations and couldn't raise taxes without triggering revolution. So they printed marks. The money supply went from 63 billion marks in 1920 to 400 quintillion marks by November 1923. A loaf of bread cost 200 billion marks. Savings were wiped out overnight. Who survived? Those holding real assets, land, factories, gold. Who perished? The middle class, holding paper currency and bonds. This is always the pattern: monetary expansion to service unpayable debts, currency collapse, wealth transfer from paper holders to asset holders. And now, let's bring this to 2025 because the exact same pattern is accelerating right now and the data is undeniable. Global debt is $307 trillion. That's 352% of global GDP. The interest payments alone are exceeding the ability of the real economy to generate wealth. The United States is paying $1 trillion per year just in interest on the national debt, and that's with rates at 5%. If rates go to 7%, interest payments exceed the entire federal budget. The trap is closing. Look at what's happening. The Federal Reserve created $5 trillion during COVID, the largest monetary expansion in American history. That money went first to banks, to corporations, to asset holders. They bought stocks, they bought real estate, they bought commodities. Asset prices soared. The S&P 500 hit all-time highs, while 40% of Americans can't cover a $400 emergency. This is Cantillon Effect in real time. The newly created money enriched those closest to the spigot before it ever reached wages. And now, with inflation running hot, the Fed is forced to raise interest rates to slow the economy, which increases the debt service burden, which accelerates defaults, which leads to asset seizures. Stage 5 is activating now. Here's what they're not telling you. Bail-in laws are already on the books in the United States, in Europe, in Canada, in Australia. After the 2008 crisis, regulators decided that taxpayer bailouts were politically unpopular, so they created bail-in mechanisms. What does that mean? It means that when a systemically important bank fails, they can legally convert your deposits into bank equity. Your money becomes shares in a failing institution. You don't own the money in your bank account, you're an unsecured creditor to a private corporation. This was used in Cyprus in 2013, where deposits above 100,000 euros were seized to recapitalize banks. It can and will be used again. The legal framework is already in place, and the biggest players are preparing. BlackRock, Vanguard, State Street, the asset management giants, they manage over $20 trillion. When the defaults accelerate, when the collateral seizures happen, when real assets are liquidated for pennies on the dollar, who do you think will be the buyer? The same entities that are closest to money creation, that receive newly printed central bank liquidity first. They can borrow at near zero rates, while you pay 5 to 25% interest. This is the wealth transfer mechanism completing its cycle. They create money from nothing, loan it to you with interest that was never created, wait for mathematical default, seize your real assets, and consolidate ownership of the world's productive capital. So what do? How do you escape a mathematical trap? First, understand that cash is not safety, it's slow confiscation. Inflation is running at real rates of 8 to 12% when you include food, energy, and housing, not the manipulated CPI numbers. Your purchasing power is being eroded by design. Second, move wealth into assets that can't be printed. Land, productive businesses, skills, commodities, potentially Bitcoin and precious metals, though those carry their own risks. The key principle is own things that produce value or have intrinsic utility, not paper claims on value. Third, minimize debt exposure, because when the defaults cascade, debtors will be the first casualties. If you must have debt, make sure it's fixed rate and backed by productive assets that generate cash flow. Fourth, develop skills that have value in any economic environment. The ability to build, to grow food, to generate energy, to provide medical care, to solve problems. When paper wealth evaporates, human capital is the only form of wealth that can't be seized or inflated away. And fifth, understand the timeline. The mathematical trap is closing now. The debt to GDP ratios are at World War II levels, the interest payments are becoming unsustainable, the central banks are trapped between inflation and deflation, and the asset bubbles are at historic extremes. The next 3 to 5 years will determine whether you're on the winning or losing side of the greatest wealth transfer in human history. This isn't a prediction, this is arithmetic. When you create principal but not interest, when you force exponential debt growth, when you concentrate money creation power in a small cartel, the outcome is mathematically certain. The only question is timing and magnitude. And every indicator, from the yield curve inversions to the commercial real estate defaults to the sovereign debt crisis in Europe and Japan, every indicator is flashing red. The 7-stage debt trap is at stage 6, approaching stage 7. Those who understand the mechanism can position themselves as buyers when assets are liquidated. Those who don't will watch their paper wealth evaporate. and their real assets get seized. The game has been running for 330 years since the Bank of England charter. The players have changed, the technology has changed, but the mathematics haven't, and mathematics always wins. In the next video, I'm going to show you exactly which assets the elites are accumulating right now, the specific timeline for the next crisis phase, and the 3 jurisdictions, where you can still protect wealth from bail-ins and capital controls. But that information is useless if you don't understand the mechanism I just explained, so if this opened your eyes, hit subscribe, because what's coming will make 2008 look like a practice run. The debt trap is closing, and only those who see the pattern will survive what comes next.